Good morning, UPBOptionMillionaires.com. It is January 14, 2019. It's a Monday, and S&P 500 futures sharply lower to start the trading week. S&P 500 futures down over 0.8%. NASDAQ futures down over 1%, 1.1%. And if you look here, we're off our lows too. So we could possibly revisit these lows that we saw after the European markets opened. The VIX is back over that 20 level, actually just dipped below it briefly. But each time we've dipped into this sub 20 level, it's almost like a cat sticking its foot in the water. All of a sudden it rockets back up, and that's what we saw here. To start the week, we're rocketing back up over that 20 level for the VIX. Certainly does not imply a market that's was calm and happy that we saw on Friday. And you know, Friday's action really didn't dictate this move to the downside for the VIX. I think this move to the downside for the VIX on Friday was more of just a narrow price action that we saw. One of the narrower days that we saw for the market. This week we have options expiration week. We have earnings season kicking off. We already see it this morning. The initial reaction, Citigroup reported earnings. We have a lot of banks reporting earnings, JP Morgan Chase, Goldman Sachs. The initial reaction for Citigroup was to the downside. We've recovered some of those losses, but still down almost 1% for Citigroup, despite a beat. And this is going to be important here going forward, because I think the earnings reports are going to either confirm or deny the recent price action. And, you know, what we saw last week, a stock like Constellation Brands, which soared to record highs late in 2018. Well, Constellation Brands has been pulling back since the highs at the end of September, October. So they reported earnings, moved up to almost record highs, and then have been pulling back ever since on no news, just with the market. And guess what? The earnings report came out last week, kind of confirmed the price action, kind of saying, hey, this price action wasn't just following the market, but clearly the earnings report was not going to be good. And that's kind of what this price action was telling you. The market is forward-looking, smarter than both you and I and everybody else put together. And the price action that we saw from the highs in October down to the lows was confirmed with this earnings report. You can see this candle to the downside here for Constellation Brands. Is that something we're going to see for JP Morgan Chase, Goldman Sachs? I mean, if that's the case, we're going to be looking at for JP Morgan Chase, despite this nice bull flag that's setting up here. A move down to the low 90s, Goldman Sachs, a move to the low 150s. For Goldman Sachs, a $25 move to the downside. Now, if you're bull in this market and you want to look from a long-term chart perspective, I mean, we're seeing moves that we haven't seen in quite a long time, levels that we haven't seen in quite a long time here for the market. And if you look, the last time we had this kind of pullback was the start of 2016. The market started pulling back the end of 2015 into the start of 2016, finally bottomed in February. And at that time, a lot of recession talk, a lot of talk how the market had topped. That was it. And then we rallied, I don't know, something like 15 in the next 17 months, something crazy like that. I could pull it up from a month perspective. But yeah, look at how many months we were up from the lows that we saw in February. We had one red candle all the way up to the start of last year before we pulled back twice, and we've been pulling back a little bit. And now, if you look, we're getting the same kind of talk here for the market. We're rolling over, we've topped, there's a recession coming, global growth is slowing. So there's so many reasons to sell this market, and yet every time this market has looked like it's ready to collapse, that everybody's, you know, going to sell, there's so many reasons to sell this market, and we probably have more reasons now than ever before. It's rallied. So if you look from a momentum perspective, from a 5-year weekly chart, we're about to peg here a possible positive momentum change that we haven't seen since the lows in 2016, which really marked a tremendous bull market buy the dip opportunity, where the market fell in only 1 month out of something like 15, 16 months in a row. Is that what we're setting up for? It seems hard to believe, especially this morning when we're down over 1% for NASDAQ futures and almost 1% for S&P 500 futures. But if you look, we get a possible move, at least from the short-term relief rally that we saw off the lows in December, get us up to this 265 level on the SPY. Hard to believe. But, you know, the action we saw, especially last week, a lot of downside starts followed by recovery of those losses. We saw that on at least 2 occasions last week, which implies possibly buy the dip is back, something to keep an eye on here for the market. So could today's downside action be a possible another buy the dip opportunity? Look at the NASDAQ. Very similar pattern here. We're getting that momentum buy signal. The MACD is curling here. Possible more move to the upside for the QQQ, 165, 170. And of course, leading the way, which has been leading the way since you go back to the election, November 2016, and also to the downside. Remember, small caps were leading the way to the downside. Before the market, the S&P 500 was moving to the downside. Small caps were moving first. And the same thing happened with reversal. So we got pretty oversold here for small caps and setting up for what has already been a really sharp reversal, but a possible move up to 150, 152, 155, and back in this channel that we saw from the pullback from record highs. So small caps, NASDAQ, S&P 500 still look like more possible potential for at least relief rally or the start of a new bull market. Pretty hard to believe here, especially with interest rates still getting hiked. You know, the Federal Reserve pulled back on them, but certainly something to keep an eye on is record debt amid higher interest rate environment does not spell, I don't know, economic expansion. I mean, these corporations, you look at a Domino's Pizza, which got upgraded last week, has been piling on the debt since the lows in 2009. And Domino's Pizza was a stock that was trading, what, $10 a share? And look at the move it's had to the upside. Now, if you want to look from a 10-year monthly perspective, Domino's Pizza, it's got a nice sell signal there. Possible move back to the low 200s. They've been piling on debt, and amid a world with higher interest rates, that would be a problem because they've been utilizing their debt to buy back stock and issue dividends, not reinvest in the corporation. So a stock like Domino's Pizza would be something that you would look for significant downside amid a higher interest rate environment. But with the Federal Reserve kind of dialing back a little bit, we'd be setting up for a sharp move to the upside, possible new all-time record highs in 2019. But again, short to medium term, we got to look at these earnings reports, starting with the financials to see, hey, was the recent price action a reality? Is it, you know, if we see JP Morgan Chase later this week in the low 90s and Goldman Sachs back to the 150s, I mean, that sets us up for a pretty negative year because that means the forward-looking price action of the market, which is always looking forward, was confirmed via earnings. And if we see a break even lower, that's going to imply that, yes, indeed, that recession is here. Now, we've had so many top calls for this market. We've had so many times when it just looked right on the precipice. I mean, you look at a stock like even Apple, which has been pulled back 3 times in its history, pretty sharp pullback. But this is one of the nastier pullbacks we've seen for Apple since the lows in March 2009. You go back from an all-time perspective here. I mean, it looks pretty dramatic, right? I mean, each of these pullbacks have been, all right, we had the one pullback here into 2009. We had another leg lower in 2013. Anybody who remembers back in 2013, the growth story was over for Apple, and then we rallied again up to 120 before pulling back again. This rally looks like, you know, you could look at it 2 ways. Did we really get that much far ahead of ourselves here for Apple? Or is this a top? That's the one thing that concerns me here, especially a stock like Apple, where these pullbacks have been more modest, more moderate, where we've gotten almost what you would look for at a top for a market would be some sort of a blow-off euphoric top. Now, if you want to look for a stock that has led the market, you know, one of the largest companies in the world by market cap throughout the rally that we saw the last couple of years, blowing off like this, yeah, I mean, it's definitely a concern. But again, let's look at the earnings report. It's going to be one of the more important earnings report seasons that we've seen since the lows in March 2009. Are we going to see a confirmation of a possible top for this market, or is it just going to be, you know, some sort of a reset before we move to all-time record highs? All right, UPBOptionMillionaires.com. I'll see you in the chat room. Everyone have a great trading day.